Ladies and gentlemen of the crypto space, we're live on a Monday, July 10th at 11:32 a.m. As far as Gump says, the life is like a box of chocolate stuff, but you never know the changes that are occurring on a short time frame. But we have some great confluence suggesting significant changes from a larger time frame perspective. And you're going to have significant volatility in the shorter time frames, but I'm tired. I'm more seasoned. I'm older, and I don't really have patience for the shorter term time frames. I just want to get ahead of the market over the next 1, 2, 3, 4, 5, 10 years and let the market come to me. Patience. I wish I had this kind of patience and understanding of the market back in my 20s. And, that was 20 years ago. I'm 40 years old now. So imagine 20 years into the future from now with the perspective that I have now. I would have put so many more quarters on the railroad track as compared to now. Don't throw quarters at the railroad track. That's what it's like when people are in a frenzy during extreme volatility in markets. They're throwing quarters, trying to catch short-term trends. Oh, is the train coming by? Oh, I'm about to throw a quarter. I'd rather place a quarter and, all right, it'll be here next month, next year. And in the meantime, you know the deal. Cash flow is all that matters. So I got some charts up, and that'll hopefully indicate what I'm trying to suggest about significant structural change. I don't have charts for demographics, but generally speaking, Peter Zeihan is the great authority on demographic change, and we know of the demographic decline in China. The long-term demographic boom, that's the play out in India, as Goldman Sachs says, India to overtake the U.S. as the second largest economy by 2075. Second largest economy. China is the largest economy. Now, the only thing, as Raul talks about, that would compensate for a decline in demographics and the maintenance or increase in productivity is technology. So it's a very interesting long-term trend that we will observe, we will watch. On the screen is 10-year government bonds since 1912. And if this doesn't scream structural change, I don't know what does. I mean, obviously, just from a technical perspective, it's completely violated lower highs and certainly lower lows, where we've produced a higher low from a 6-month candle perspective, showing support on the 50 SMA for the first time in, I don't know, the last time we did something like this was probably back in 1956. Was a breach to the upside. It broke down lower and pushed back up. So it wasn't even really support, but you can't really compare current market conditions to market conditions back then. Everything has changed from a global economic standpoint of the way currency, everything about currency has changed since back then. But structurally, technically, clearly, that's a resistance, flipped support, retest, and we're not at the higher high. But incredible, if you print a higher high, you're above the TWAP on the 6-month on 10-year bonds, which we literally just started getting technical data from since 1912, because we're looking at the 6-month chart. There just isn't that much data. Gotta love this pulled out time frame. It really gives such an incredible structural perspective of things. Now, this is so meaningful from a global currency perspective. Just it tells you such an intimate amount of information about the composition of currency globally, especially what we know started occurring in the 1950s and what we know occurred in 1971. I mean, this just, the quantity of currency globally went parabolic starting in 1971, and it just went through the roof starting basically in 2020. And with higher rates that we're seeing right here in this chart, this is right down the pipe of the bond market spectrum of the yield curve. This is indicative of lack of pressure going to be placed on dollar FX, as I've suggested. You have a discount to face value because as yields go up, the market price of these instruments go down, which means you're able to buy them on the market at a discount relative to face value. But we know the euro-dollar system has a capacity to turn pristine collateral into dollar liabilities. Obviously, there's many more claims on collateral than there are actual physical dollars in the system. Actual physical dollars in the system is relatively small. Actual physical dollars in the system is literally 5.593 trillion, which is relatively small considering the numbers that we've discussed over the years, and literally just numbers domestically in the United States with USM2. These are basically the total amount of deposits in the system between various types of deposit accounts. So there's $20.67 trillion worth of various forms of dollar liabilities in the U.S. domestic system, and only 5.593 trillion actual dollars that are backing those claims. And then when you go out to the global landscape from a euro-dollar standpoint, we know that that is, frankly, basically zero. Probably a quadrillion dollars in liability form between domestic U.S. and international. But that's not going to stop the system from doing what it's doing. And historically, at least since 1982, we have been in a decreasingly favorable market for printing, offshore printing of US dollars, because every time there is some sort of catastrophe, they would title it a risk-off market, and you would have a cyclical capital flow from risk markets to this market as being seen as the place of safety. And that would decrease the liquidity in the system. But this structure is very indicative to me that international liquidity conditions are well positioned to expand for the first time to a significant degree structurally. Like if there's a higher low, if we have a complete risk-off event and U.S. equity markets sell off into the bond market, and we find support on the 50 SMA, maybe we have a giant wick down to the TWAP. I mean, we're that far above the TWAP on this 6-month chart. We have a giant whip down to like 2.3% on 10-year bonds, and it closes above the 50 SMA. That'd be just crazy from a technical standpoint to see that kind of support on yields. And that would be very comforting to international market actors to use this collateral to create dollar liabilities in the system, increasing global liquidity of currency units, especially outside of the U.S. I'm much more interested in conditions outside of the U.S. as compared to conditions inside of the U.S. I don't have that kind of exposure to U.S. equity markets. I don't even have that kind of exposure to U.S. tech equity. The vast majority of my exposure is to international markets vis-a-vis crypto markets. They are not a U.S. market. I find this chart absolutely fascinating. And then if you go over to MOVE, bond market volatility, this is also indicative of increasing liquidity in international conditions, international liquidity conditions. As this comes down, we obviously had a very large spike last week, putting us back to the TWAP. It was like a 20% move in a single week. Quite an extraordinary incident of volatility. But notice the start of the wick. We are slightly above the TWAP. This is still a massive shooting star candle. And this every chart we have to say, let's watch. But structurally, this is 18 plus months of a rolling top, a much more structural rolling top as compared to what occurred in 2008. That was much more pronounced. This thing has been lingering in a state of escalated volatility for 18 months. I mean, they're about to print how much treasuries? I mean, that is probably a great indicator for the increasing liquidity in the treasury market. Increasing liquidity is going to decrease volatility, and as they're adding treasuries to the market, that should put depreciative pressure on U.S. debt instruments. So between the increasing of treasury liquidity, the pressure up on yields via the Fed funds rate as well as Treasury market capital raise is the precursor to increasing liquidity conditions internationally as the euro dollar market will facilitate. That's quite fascinating to me. We're interested predominantly, folks that listen to me, in international liquidity conditions to have a sense of the directionality of crypto markets. You're not mostly interested in domestic U.S. liquidity conditions, albeit that's kind of like a bit of nitro, because obviously, if the Fed balance sheet has a directional move upwards that is increasing in domestic conditions, and we know there's a very tight correlation between risk markets and the Fed balance sheet. But I would argue that the better perspective is the effect of the Fed balance sheet in overall pressures and international liquidity conditions. That is what affects the risk market that we have most interest in. Um, Quite a fascinating chart. I mean, these boys tell a story, and the story they tell is not necessarily the most informative for our interests. It's probably most useful from their interest. They're trying to craft a narrative to push the market in various directions to manage their required financial policy objectives. But when you look at the data, it kind of tells a bit of a different story than the regulators really say. And that's important to be able to peer through the bullshit. And it's not necessarily bullshit, it's just their story, and to peer through their story and see the actual story that's occurring. Raul's in the house, Dan's in the house, Data Style. Hi, Cap. I'm looking for an entry in Aura. I see a good discount. What do you think? Let's talk about some technicals. I want to look at some crypto charts. Well, you never know where bottom is, but structurally, you're towards a significant line of hopeful support. If we fall below the purple box, we're into a bit of uncharted territory. Um, so, does it get cheaper? How much cheaper? Could always get cheaper. You never know where bottom is. The question becomes, um, what kind of capital allocation methodology are you subscribing to? If it's a subscription where you want to see Aura go to $3 and then liquidate it for 100% return on your allocation, this might not necessarily be the chart or the asset to do something like that for. You'd want something with significantly more liquidity, probably easiest to play like a Bitcoin, Ethereum leverage type of position for capital gains, in my opinion. I'm not too fond of when particular conditions reemerge. I don't think I'll have much interest in altcoins from a capital gains perspective. I mean, unless something is screaming a technical structure, but relatively the liquidity for altcoins is so small as compared to the macro assets. And there's really only two macro assets that are most interesting, and that's Bitcoin and Ethereum. And now we have all these on-chain, perp protocols and just great environments for gaining potentially small leverage exposure to volatility in those increasingly liquid markets fast, so you can respond quick. With capital gains, you need to respond quick and have meaningful instruments to allow you to respond quick. So I think carbon is actually interesting what Bancor evolved into, especially heading into the upcoming capital gains cycles. I'm going to keep an eye on what they're up to. Those are the kinds of tools you want to be able to express your sentiment on the directionality of markets. You guys know my opinion regarding this asset. I relocked my position maybe 2-3 weeks ago at this point, and I expect this to be whatever direction it has with regard to price point is irrelevant. I considered it a purchase, and in exchange for an APR. Most recently, I delegated to the warden, so I look for income on a biweekly basis that comes in. It's gonna come in. It's just gonna keep coming in, and that would be an interesting chart to chart the income that these protocols produce. We look at the price point of these protocols, but what about just the income that they produce, the yield, the dividend, the cash flow, whatever you want to define it as? Um, I would find that much more interesting at this point with regard to how I engage with these markets. Killis is in the house, a pleasure. Ian, good morning. Sir Joe, Athena made another live one. It's been a bit. It's a pleasure. Bill, good morning. Have you ever had an interest in doing a series on streams for DeFi beginners? Had some friends reach out asking for tips. The problem is it's not DeFi beginners. It's really capital management beginners. It's the concept of knowing what money is, knowing what dollars are, knowing how the financial system works, because ultimately someone getting in, they're like, is the market going to go up or down? And that's the first thing anyone thinks. They buy something, is it going to go up in price? So to have a sense of whether it's going to go up in price or not, that's exactly why we're looking at the bond market. That's exactly why we're looking at the DXY. That looks wonderfully structured to depreciate over the coming years, especially with China tightening. Well, where did that flip in the script come from over the last little blip in time? And that's what we're seeing here. What I find most interesting from that standpoint is Move having its spike last week, but the dollar not flinching at all. Typically, there would be fear, and that would be that liquidity would decrease from the market. So, Bill, that these are the types of data that are imperative to look at to get a sense of whether you're going to have appreciation or not. Now, I don't think we're going to have significant appreciation, like a splash of liquidity in the system in the short term. That splash of liquidity that we had in 2020 and earlier cycles in crypto history is probably likely to come again, but I don't see it on the radar. Maybe it is something that's going to be unexpected in response to crisis, so on and so forth. But these look to be very low volatility, increasingly well managed liquidity conditions as compared to historical events. So ultimately, that's why capital management is such an it's a process. It's not get in. You have to retrain your mind and define rules and define objectives, expectations, goals. Look, I'm not even looking at price points anymore. I want to understand the direction of markets, and I'm looking at 6-month time frames. I look at the Bitcoin chart. This is the Bitcoin chart that I look at. Why is this on the left? Move scale to right. I mean, this is literally the Bitcoin chart that I look at. You're not trading this from a technical perspective. There's nothing technically significant to get from this chart. What I get from this chart is structure. What I get from this chart is novice capital allocators, a lot of FOMO, a lot of absolute insanity, degenerate behavior that produces wicks like this. In this regard, we had less irrational actors back in 17 and 18 during these candles. I mean, these wicks are just preposterous. But structurally, we never breached the TWAP to the downside on the 6-month chart. This is a chart not often talked about when with other social media folks that do charting of these types of assets. I mean, you're not trading a 6-month chart, but this chart screams of structure and directionality and support. Look, you had great support. I mean, you had great support back here in 2020 on the TWAP, which is very interesting. I believe this was March of 2020. Would you look at that? It was a little bit above March of 2020. Obviously, the candle body close is a little different between the monthly and the 6-month, but you basically close right on the TWAP. The average price from a 6-month perspective. I mean, you could zoom in. I think it closes right, pretty much right on it. There's a little bit of a wick below it, but that's kind of the same thing of where we're at right now. In fact, the open for the 6 months was right on the TWAP, which is quite surreal to see. So this chart basically screams to me something I tweeted a little bit earlier, which was one, who's left to sell? Markets depreciate and when people are taking profit, but if you no longer have profits, uh, you only have trading like intraday, intraweek, intramonth volatility and volume and capital gains participants. But structurally, you have actors come in that are accumulating. They just want to own it and hold it and have bearer assets, and they are removing supply from the system. And that ultimately creates volatility events in the prevailing directionality, which is to the upside, as supply gets removed from circulation. And the same phenomena is quite visible on the Ethereum chart. I mean, structurally, Ethereum and Bitcoin are almost identical from a technical perspective when you zoom out to the 6-month chart. In fact, Ethereum looks a bit stronger. It didn't even get to the TWAP on the H1 2023, which is earlier this year, as compared to Bitcoin, which did get to the TWAP H1 2023. So if anything, Ethereum looks much more structurally strong from a 6-month chart perspective. Once again, this is not a chart that is often talked about by social media commentators. Even, very popular Bitcoin hosts as well as Ethereum hosts, they're not comparing from this time frame perspective. So this looks quite nice from a directionality perspective. Where's the depreciation going to come from? It's going to be a malfunction in the system, in which case it just fails, and then everything fails, and then we all might as well get picks and shovels and guns and ammo and start hunting and shit. Anyway, hope that helps. James, morning cab, catch you in the office live today. Yes, indeedy. Dan, can you please talk about the Curve Ants and other new Curve ecosystem players? Yes. So I mentioned in 1971 what occurred with the dollar, and it's in good part what Nixon did by talking with Saudi Arabia and pricing oil in dollars, oil for dollars. But it was also partly a deal where excess dollars would be recycled back into U.S. treasuries, which ultimately, for the last 50 years, have been used in reserve as money. As a reserve value, probably best said. So that is a phenomena that I've observed in the crypto markets over the last couple of years. So I've said to many folks with regard to Curve, there's all these derivative protocols and very popular derivative protocols, and Conic and Convex, obviously. And they have their own monetary policy, their own token, which they use as an incentive system. And that creates all sorts of capital flows within these liquid staking derivative protocols that have all these, unique characteristics and all these opportunities and reasons for people to participate. But there's 4 more coming online. And ultimately, this rings such a similar tone to me as compared to what occurred in global macro financials with regard to the entire world consuming U.S. treasuries in reserve as storage of value. And how do you do that? You have to recycle currency because you need dollars in order to buy those instruments. So those dollars are removed from circulating supply, cycled back into the TGA to sell these debt instruments, and these debt instruments are used in turn in the international Eurodollar market to print offshore dollars. So it's quite fascinating the way traditional finance handled the sterilization of excess circulating supply, but that's exactly what every protocol that has come online, especially Convex. Look, Convex is what stabilized Curve back here in 2021. Let's zoom out. I got too much data. Monthly. So this is basically Convex. Convex stabilized the Curve back in beginning of 2021, and we started that price appreciation, November, December, January. And that was the start of this entire move up, and that was just Convex. And maybe Convex was here in 2021. Anyway, dates aside, excess circulating supply of Curve was sterilized. That's the only way you can get price appreciation in an asset that is creating so many currency units in an inflationary way. Um, period. So this depreciation is obviously part of the liquidity cycle. People are capitalizing. There wasn't as much recycling. There wasn't as much speculative buy pressure. There wasn't as much participants that wanted access to the cash flow. There were forced sellers left and right because people were speculatively holding Curve. Everyone was like, Curve is going to go up, up, up. Curve is not a capital gains asset by any means. So that accounts in almost all regards for the depreciative leg. Why we have bottom, an inverse head and shoulders. We had this big blow off bottom down to 38 cents because of the short attack on Ave. But we're clearly past accumulation phase where who's left to sell to push it down to a lower low. All of it was bought. Everything that was sold down to 38 cents was bought. And who's going to sell at this price? You sell when you're in profit, but if the average, if we put this chart on for a year, this will actually be interesting. Let's do this. Input, anchor period, year. Interesting. Oh, I don't want the year. I want all the way back to here, back to June of 22. Let's see if we can get there. Anchor period. Quarter decade, no. Session. Auto. I wish I could get a better anchor period on this. I'm not going to waste time on it. Okay, but that's enough for now. Look at the volume. The volume is above. So all the market actors, and that's probably because of this giant short squeeze that was on where the short attack was squeezed to the upside. All those market actors are currently underwater that bought, above a buck. Who's left to sell? If we had this price appreciation in this low volume phase, it was all bought. Anyone who's at this price that bought in this range is at marginal profit at best. Why would they sell if they think this inverse head and shoulders is directionally indicative of trend reversal to the upside? Thing screams of not capable of producing a lower low, and that's exactly what an inverse head and shoulders historically indicates. So excess circulating supply has clearly been sterilized by the already existing Federation participants, and we're about to have 4 more Federation participants come online. Now, folks, I can see why people would be interested in the tokenomics, the opportunity with the protocols that are going to be sterilizing excess curve supply, and that's fine. I think everyone has to make their own choices. I always say that, and there's no reason, from my perspective, to diminish the potential opportunities available from these, and uh, these additional consumers of supply, and they're very interesting, all of them. They're all trying to bring something unique to the table, and they're all going to be attractive in their own right. And my perspective from a base layer maximalist is that, yeah, they're going to attract a lot of participants. They're going to dry up a lot of circulating supply, and that's going to do exactly what I wanted to do from a base layer. I mean, generally speaking, in the long run, my expectation is even vote rentals becomes marginal compared to the revenue just from trading volume, and trading volume will obviously be additional to interest payments on CRV USD debt, and obviously trading volume is also a manifestation of the peg keepers and the AMO activities to manage the peg. So I expect that revenue to eclipse potentially vote rentals to a significant degree. Now, I'm just speculating right now. That's just maybe a relatively early gut instinct, and maybe that's not the case. Maybe vote rentals remain extremely lucrative heading into the future. Curve at 5, 10, 15, $20, and that just is a very interesting directionality to potentially consider. And I don't have on my radar, in my opinion, the expectation of price appreciation to that degree. I'd be very content with cyclical price action between 5 to for years to come. Price appreciation is not something I have part of what I'm looking for my portfolio. I just want the cash flow, and I expect that to occur, especially if we cycle between 5 and 1 for the next years. But if we see price action significantly depart from this region, that changes the equation to a significant degree. There goes the yield on all the LP positions. That's going to drive a huge amount of liquidity into the system. And that's going to change the equation for protocols that want to finance liquidity of their respective asset. That'll significantly increase the value of their capex. They're spending X amount and they're getting a multiple of that X, whatever, 1.5, 2X efficiency on the liquidity that is being incentivized to participate in their respective LPs. So we'll see. I mean, we're clearly a long ways away from entertaining that reality from a significant price appreciation, of a significant price appreciation. And all I'm interested in is directionality reversal to the upside, which indicates that this protocol will continue to exist and continue to function as it has been functioning. And that is only bolstered by the reality that 4 new Federation participants are scheduled to deploy to a production environment. Hope that helps, Dan. That's generally my sentiment. I know it's not necessarily exactly what Bill was talking about. Like, new participants are like, what is this crypto? What do I buy? The expectations are not set. Over the years, when we've done on this stream, is we've discussed so many different expectations. We've been able to refine what we're hoping to happen, what we're expecting to happen. We have such experience with these markets. It's very hard. If you recall, all of you guys, if you recall when you were first starting to digest this type of material, it's very intimidating. And all you really looked at was number go up or down. And there's so much more to it. There's almost personality to these data sets, almost, a rhyme, a rhythm, which is what we talk about lately with regard to flows and pressures, and that's really what liquidity is, because I've said capital flows from underperformance to outperformance. So that means you have a flow from two different a source of liquidity and a destination for liquidity. And that flow is because of underperformance where there's more liquidity and outperformance where there's less liquidity, so the flows go from one market to another. So, and to really understand that, you have to be able to visualize it to a degree. And that's not necessarily, it's actually quite intimidating from an entry-level perspective. Hope that helps. Bill, also one more cue. What do you immediate effects of EIP 4844, the DeFi ecosystem, besides a reduction in gas fees? I don't know what's going to play out with regard to the L2s. Reduction in gas fees should reduce burn significantly, so we could have a decrease in deflationary pressures on mainnet. I don't have a clear picture of what plays out with the L2s. I mean, if you have a significant reduction in gas fees, transaction fees on the L2s are basically going to become zero. They're already ridiculously cheap compared to mainnet. What are you going to have, pennies? You have transaction fees that are pennies? I mean, it's suitable for micro transactions. So what's the significance of liquidity on the L2s? I don't see it right now. What I see is the same thing occurring on the L2s that has occurred on mainnet. But mainnet has the instantaneous finality. A block clears and your transaction is done. It's printed to the chain. It's final. It's not the same thing with the L2s. So in the back of my mind, I'm like, where does liquidity flow? Liquidity flows based on risk profile. So you're obviously going to get significantly more liquidity inflow into mainnet as compared to the L2s. That's a very simple observation. So then another question might be what kinds of liquidity, seeking what kind of activity. So obviously L2s are a no-brainer to me from a gaming perspective. I mean, look at Starknet and what I do with Gods Unchained and Immutable. That's big stuff. I have a high opinion of that game from a historic, nostalgic Magic the Gathering perspective. So they're significant. Are they significant from a financial activity perspective, from a credit market perspective? If you're going to borrow $1 million, $5 million, why are you going to do that on the L2s when you have significantly less liquidity? Very different collateral composition. You're talking about Ethereum that's stuck in bridges. I mean, you're not. I, it's not native. It's not pristine collateral of sorts, respective of the chain you're on. I mean, Ethereum. I mean, there's no approvals. It's a bearer asset that's protected by the security of the entire network. And obviously, there's relative securities of the different networks to consider. But that's very meaningful, and that is much more meaningful when you're talking about denominations or quantities of capital that are way beyond the average actor. We're talking about institutions coming into the space. If you're going to borrow $100 million, you're not going to do it on an L2. There isn't $100 million on an L2 that's available to borrow or create. There isn't enough collateral. So it's not even possible. But that's the kind of activity that I want exposure to. I don't want exposure to the smaller transactions. I want exposure to the potential large transactions, and they're not going to occur on the L2s. They'll occur on mainnet. Hope that helps. Paul, good morning. Dan, thank you. You're welcome. I guess I just wanted to know more about exactly what they do, what makes them unique. Well, they have interesting tokenomics. I'm not going to dig into each one. They're LSDs. Some are LSDs of LSDs and are designed to aggregate LSD. I mean, it's kind of like YETH in regards. And obviously, they have monetary policy strapped on top, so they have their own incentive systems to bootstrap liquidity and do all the shit that all these derivative protocols have done thus far. So in regards, they're going to do exactly what Conic and Convex and pick another derivative protocol, what they've done to the circulating supply of Curve. They've dried up Curve from circulation, and all of them boast the quantity of Curve that's permanently locked. And that's what these four protocols will do. Each with different characteristics, but maybe obviously I'm not capable of speaking to their unique characteristics because I'm not too interested in their unique characteristics as compared to their effect on the overall system, being a base layer maxi, of course. So, on Discord, we could, in the Federators section, we should probably dig into their unique characteristics. Maybe that would be nice for many folks that are on there that are interested in exposure to the Curve ecosystem, but not necessarily exposure at the base layer. I've said, and the most important thing that I could offer to anyone that listens to me is the common denominator of a capital allocation, of an investment, APR. It doesn't matter. You'll see Protocol A, Protocol B, Protocol C. Great names, great teams, great products, great incentives, great adoption. If they're all 20% APR, what's the differentiator? You don't deploy capital to something that produces 20% APR if it does the same thing as something else that produced 20% APR. The whole question is, what is the likelihood that that rate of return is going to continue into the future? That's what matters. So I've started to see all of these protocols as the same exact thing. And it all reduces to how much cash flow they're surfacing to you. Sustainably, I might add. Hope that helps. Austin, a pleasure. 25 people in the stream. 8 likes. Hit that thumbs up button. We can do a little bit better. Well, I've gone over the charts that I think are most important. Structurally, I think things are going to head in a appreciative direction. Uh, I mean, from a monthly standpoint, both Ethereum and Bitcoin are above the TWAP. That's a very interesting technical position. One, when we breached the TWAP back here in June of 2019 on the monthly, it was weak and it was rejected. When we breached the TWAP here in March of 23, it was not rejected one. It was a large wick to the upside, which was sold, which means there was excess supply, folks in profit that were liquidating. Then we had a wonderful spinning top candle, which is very interesting because that is directionally indecisive. This is from a monthly standpoint, I might add, but it closed well above the TWAP. Then we had a third month. So I guess we didn't break out back here in March, but we broke out in April, or we opened above the TWAP in April. But then in June, this is a large inverted hammer, or a large hammer rather. Uh, to me, one, it the wick on the bottom is above the TWAP, which is wild. So we have 2 months of confluence suggesting you're not going to get below this TWAP without a serious fight. Like there's plenty of people that are in the market to accumulate below the current price point, which would have to be above 1,593. $300. That'd be a significant double-digit move to the downside, and you'd still be structurally above the time-weighted average price. Now, bear in mind this is from a monthly perspective. So, how long does it take for the TWAP to start to slope upward? You're talking about end of year. Look where my cursor is right now, December of 23. So it could take many months for this TWAP to structurally change direction to the upside, and then give you your months of of nice directionality that everyone's looking forward to. Same situation for Bitcoin. In fact, Ethereum is a little bit better structured with regard to a breach to the upside. It's almost as if the breach to the upside in May of 2019 looks structurally better here. So we actually had an expression of support on the TWAP. We breached to the downside, and it took an entire month to close to the upside. So there's you could compare. They're very similar in almost all regards. If anything, we didn't even touch the TWAP on the retest for Bitcoin. So I've been obviously talking about Bitcoin more and more, and let's talk about that for a second. I don't consider Bitcoin an investment. I don't consider anything that is absent cash flow, that doesn't produce cash flow. It's not an investment. Investments pay you to own it. You own a piece of an enterprise. If anything, this is more of a money, or at least as useful as a money. So if you have cash that you would typically store in a stablecoin, I keep it right now denominated in a bit of Bitcoin and a bit of Ethereum. But if I need to spend money, that's where my money comes from. It's money, it's spending money. Food for thought. So they're not, I mean, maybe Ethereum's an investment, but at what, 4, 8, 12% return? I don't think anything's offering 12% on Ethereum right now from a risk minimized staking position. Unless maybe you're doing it, not even if you're doing it on your own, but then you still have risk of slashing depending on your network connectivity and your infrastructure reliability. Resiliency is probably the best word. So unless you have millions of dollars, Ethereum is not really an investment, and I don't even deploy it to a staking position because that's my cash, and I'm not taking any risk with my cash. I need my cash. I got shit I got to do. I got things I want to do. So that's just the denomination of my cash because they're bearer instruments, and I've been talking recently about my distaste with recent banking experiences, and I just want assets that are bearer. I bear them. I own them. I hold them. They're not in a bank, and I have no counterparty complexities, or I minimize my counterparty complexities where applicable or where possible. Hope that helps, guys. Ian, Cap, thank you for the insight every week. I understand so much more about money and crypto today. It's all because you gave me a glimpse into the way you digest traditional financial system. You know, good part, I'm a digester of digestors. I mean, a lot of my path started with like Real Vision and a lot of Raul. You know, Brent is meaningful. Brent Johnson, Luke Groman, George Gavin has some great content. Most recently, Michael Howell, with regard to what he talks about regarding liquidity. That's big stuff. A lot of the stuff that he talks about, I thought of before I found Mike Howell. And when I heard Mike Howell, I was like, oh shit, that's cool. So his content is really good. And I think they're speaking towards what actually is playing out. I think they have a good grip on what's driving the system nowadays. And I tweeted most recently, yesterday, what I really think is going on. It's a giant game of collusion, global collusion, because of debt to GDP. There's no way any of this could get serviced. They're going to have to drop rates so they could roll over the debt, so they could recycle, reset the system again, reset the interest rates, because how are they going to finance all this shit? Right now, the trajectories of interest payments are clearly on a death spiral. So they're going to have to cyclically reset. And what they're trying to do is obviously tame domestic market conditions, consumer price inflation, with the little bit of time that they have before debt needs to be refinanced. That's probably why they increased interest rates as fast as they did, because they know they're going to have to come down even faster so that they could reset as certain tranches of U.S. securities start to roll over. That probably makes the most sense. They're probably just timing it to like the largest tranche of U.S. bonds that need to roll over, and yeah, that's when they have to get interest rates down, and they want to have rates as high as possible until then. And while they're jacking up rates, that's structurally changing international liquidity conditions to be much more favorable for risk markets. What are you going to do with the capital? When you have excess capital, you deploy it. So that's what folks are doing, and that's why we see this behavior in markets from a global perspective. Dan, you're welcome as always. M. Nava, can I ask you about Digibyte? Is there any hope for a future for this solid blockchain? Well, not currently. Technologically, it's always been significant from a UTXO perspective, but it has no financial infrastructure. It's a bearer instrument that's unquestionable. No adoption. Uh, so, it's just not something, it has a massive risk profile with regard to any capital allocation. But what's the incentive to buy it? Uh, uh, I don't see any incentive. It's inflationary. It's disinflationary, obviously. There's complexities with regard to emission that are very comparable to Bitcoin, just on a shorter time frame. Um, I I just don't see any benefit to a portfolio without. I don't see any benefit to a portfolio currently. It doesn't do anything for a portfolio to achieve expectations to the things we want to do from a financial perspective, particularly cash flow. Appreciation is probably the biggest red herring for new actors getting into the space, because that new people trying to get into investing, they're like, I want to make money. That's appreciation, but appreciation is the hardest way to make money, because that's PvP. That's player versus player. That's pure biological, analogies, predator versus prey. So folks that often get into investing are getting into the hardest aspect of investing, and which is why I've come full circle back to the concept of dividend investing. It's a very historic methodology, and value investing, and that doesn't really exist anymore in the same way it did historically. But I see great value in things that provide cash flow, and this is just not something that you really have access to in traditional finance to the same degree, with the same potential for an increase in cash flow. You're not going to have some mega cap $20 billion corporation go 10x, 100x on their cash flow, but That's the type of thing that we could see here in these markets, these credit markets, these debt markets, these derivative markets, so on and so forth. You could see 10x, 100x in cash flow. I'm not interested in price appreciation. I'm interested in the amount of cash, amount of liquidity that's flowing through a protocol, consuming its financial product. You're not going to see Walmart all of a sudden go 10x on the amount of business it's doing. It's just not going to happen. So these markets are offering something that is not accessible. Even if you see like 20%, 40% APR in traditional finance, which I talked to you guys about, I said it during the stream, everything reduces to APR and the likelihood that it will continue into the future. But from a speculative perspective, I look or I'm hoping for that significant increase in cash flow. You see a spike of 20% APR to 1,000% APR, clearly it's going to get diluted. And you're going to see a significant amount of capital inflow accessing that cash flow, which is going to take it back down from the 1,000% spike down to 100%, down to 80, down to 50, back down to 20, a full round trip. But all that capital inflow is going to mean significant price appreciation. All of a sudden, you're going to be getting 20% APR on a significantly higher price for your principal. So the 20% is what you want to see, but the appreciation won't come on the 20%. It'll be on your principal, so that 20% will be significantly more cash flow. Very interesting. Hope that helps. Noah, to save me F fees when I claim bribes, I think I'm voting for my VE curve through Try Crypto Pool. Well, you could also use those. Uh, uh, the, uh, what are they called? You know, the llama. I don't even know. I just haven't kept up. There's plenty of auto claiming, and Staked Out does auto. Got to be auto claims on the vote rentals and compounding and all these derivatives. I can't keep up with all the derivatives. I just can't. But that is a way to have exposure to base layer vote rental fees without the expense of mainnet transactions to claim those fees. I don't. There's a laundry list of those types of derivative protocols to help with the expense of mainnet. I don't have the solutions. Ultimately, in the end, I appreciate people's complexities with the expense of mainnet transaction fees, but I could only speak from my perspective, which is the story I tell. Hope that helps. Last couple of questions. Adam, hey Cap, recash. I remember you held Frax USDC on Frax. Is that still the case? No, that Frax USDC was a locked position, so I locked that thing like in 2021. Right now, my wife's banking on that. At least that's an expectation. I expect to have that amount of cash available at the end of 2024. And frankly, we've planned accordingly. And that cash will become available. And it was not a mistake to lock that cash. If I did not lock that cash, I probably would have lost some of the value of that cash doing whatever the hell was going on in 2021. I don't think I was as prepared as I am now for what to do with that amount of cash just being liquid. So I think I did the right thing in hindsight. And that's interesting because it's a fair amount of cash that I could have done a lot with various assets, but you know, navigating what has occurred with various assets is not for the faint of heart. So I think I did good in hindsight. I'm very happy I did that lock position. M. Navi, you're very welcome. Ian, do you still have a high opinion of Qidao? It doesn't have the momentum. I would under current market conditions, I would invalidate it as something to consider. It's something that I clearly have a lock position with, which has depreciated just continuously. The sentiment I get is stuff from Phantom and Dan knows a couple of things we've allocated to that just have gone down. But look at the things, that's the whole point. Look at the things that we've allocated to that still exist. The things that have shown strength, the things that have rebounded from bottoms, and that have shown indication of directionality reversal. There are the things that have not, but that's the whole point of investing. You don't need every single one of your positions to show that kind of strength, to show the indication of survival. All you need is a couple of things to overall have your portfolio succeed over the long term. Hope that helps. How come you switched to Warden? I switched to Warden because I just don't give a shit anymore, and I don't want to look at the llama for what's paying the most, and I just want to go on Warden and claim once every 2 weeks. Automation. I'm done. If I'm going to squabble over X amount of dollars, it's not worth my time and effort. That's basically why. Are there any ways to earn additional income on VE Curb? Bribes, which is vote rentals. It's not a bribe. It's protocols that are financing. They're using capex to incentivize liquidity for their respective assets, and that's probably the best way to describe where that capital comes from. It's not really a bribe, but I'm just trying. Over the years, I've tried to redefine where our income comes from. So in that sense, it makes sense. There's a financier. I mean, literally, it does exactly what has been done in traditional finance from a sovereign perspective. Incentive systems. I mean, that's what tax breaks are. It's an incentive system. So that's really what we've experimented with in crypto markets over the last years is alternative types of incentive systems and crafty financial products and services that encourage both incentivize and disincentivize various human behaviors. Very interesting from a psychological perspective. Raul, is the Warden delegation also an auto income directly to USDC? Yes, Warden will pay you in USDC. They vote for the best bribe, best vote rental fee, and they pay you in USDC. Yes, that's the deal. 21 people in the stream, 14 likes. Hit that thumbs up button. I appreciate all of you. Thank you for staying till the end. Tell everyone to subscribe. And I wish you all a wonderful day. It's Monday, July 10th. If all goes well, I'll see you on Wednesday. Otherwise, it's Friday. I will catch you guys next time after party on Discord for the most rational community in the entire crypto space. You have a good one now.